really looking forward to hearing more on today's session about the budget. It's always one of these things where we set our experts up to kind of have to really unravel this kind of a huge announcement at an enormous amount of pace. I think maybe, and you don't even have to answer this, any of our speakers that are going to come on, but it strikes me that now these things are trailed in the media, and so there are, you know, they don't seem to keep many surprises back. So maybe you've had loads of time, and you were all prepared, and they did what they said was going to be trailed, and you're kind of all over it. But there was a lot in the UK budget announcement yesterday, an enormous amount, and it's very difficult, I think, as you know, normal business owners, if that's what we would all call ourselves, to work out how does that impact me and my business. And, you know, you need people to then be able to ask these questions of, you need to go, well, this is what I think it means. And I'm going to hear from some speakers today that might tell us more about how they think it will impact you. Not just how, you know, it may be impacting your costs, how it may impact your future investment, but how do you take advantage of some of these key opportunities that are coming at us at a national level? We've always going to have questions about how does that impact us in Scotland, because some of the things that may be announced may not apply to us in Scotland, or we may need to wait to find out how they actually impact us north of the border. But you know, I wouldn't like to be in the shoes of anybody trying to kind of fix the nation's finances, invest the nation's finances, and try and also take the private sector along, because that's, I also feel that that's our role too, is to look at what's happening at a national level and work out how do we take that into our business, how do we use our business and our acumen to kind of make the best of all of that, and how do we find the right experts that can really help us in that journey. So really that's what today's all about. It's a bit of a distillation, I think, maybe is that the right word, of what happened in the announcement, what that is going to mean to you and your business, and how can you take advantage of those things that were announced, but also the opportunities that exist. And it's really great to be doing this event today in conjunction with a couple of key partners that we work with on a long-standing regular basis. So we've got several experts from MHA Henderson Loggie with us today. What we're going to do is hear from a couple of them specifically about the announcement and what some of that means. We're also delighted to have Charandeep Singh with us, and Charandeep is an old friend of mine and the Chamber. We've worked together and had some really interesting times along the way, from, you know, being down in London and representing the network and influencing what happens down there, and just working really hard, particularly in the last year as a network, to make sure that the lines of communication are just open. But that's two-way. That's about us being able to take all of the challenges and feedback from every single business that we're in connection with in Dundee and Angus, take that through Charandeep and Liz and the team at Scottish Chambers of Commerce, and make no mistake that that goes straight to the ear of the people that can help make a difference. And whether it's us influencing something that may happen and they're looking for guidance, or whether it's to give feedback on some of the things that have happened, you know, and some of the measures that Scottish Government have brought out, and the gaps and just some of the key challenges that businesses are facing. So I think Charandeep, like the rest of the Chamber network, and like you all are experiencing, we've never worked as hard. How can it be nearly a year that we've been knee deep in such a challenging environment, and ever changing as well. So today, really looking forward to hearing from our speakers. So I think without any further ado, I will introduce you to our first speaker. So Alan Davis is VAT partner and chairman at MHA Henderson Loggie. Alan will then hand over to his colleague Dawn, who will hand over to Charandeep, and then it will be back to me to come on and introduce our panel and time for questions. So if you are joining us on Facebook Live, then please put your questions for our speakers into the chat there, and we'll try and pick them up there. If you're joining us on our Zoom meeting, then please use the chat function and drop your questions in there. We'll do all questions at the end and just try and wrap it up. And there will be lots of questions, I'm sure. So if we don't get to those questions, then what we'll do is we'll aim to kind of do our follow-up afterwards and make sure that we just do a bit of a summary on anything that we quite didn't get to. So I think that's enough for me. Alan, over to you. When I can hear you loud and clear, I'll mute and get out of your way.
Okay, I think I might have unmuted myself, so if you put your thumb up, excellent.
You're all good.
Thank you very much for that, that warm welcome, Alison. You talked about trailed changes. Lots were trailed, the most obvious of which will be the coronavirus job retention extension, so that was good news. And also, you used the phrase, what does that mean for normal businesses? I don't know if any of us are normal at the moment, but lots of us are operating in our own little way, dealing with loads of other things. So what we're focusing on this presentation is the changes, but how that might affect a model business. So we have created a case study, and we'll refer to that, and hopefully that will give people a bit more context. So I'm Alan Davis, the VAT partner and chairman of MHA Henderson Loggie. I'm going to do the introduction part, bit of the COVID part. If we go on to the next slide, I'll specifically pick up the VAT points, which are relatively thin but interesting, and then Dawn will pick up direct taxes, and as you say, we'll pick up the questions later. So, what COVID specific measures were brought in or announced, and as I say, what we're going to try and do is just apply that to an imaginary business, and we've called it Tayside Agricultural Cafe Limited, TAC for short. It's got a farm and manufactures innovative agricultural machinery. It's got 100 staff, many of whom are currently furloughed. So that we'll be interested to hear what's changed there. They've got the usual shop and cafe at the farm, and the business is owned by Mr. and Mrs. Henderson, who are in their 50s, thinking of retiring. And they've got 2 kids in the business. So we're going to try and kind of profile that kind of business based on what their structure is, and apply some of the changes that we've seen announced. So what were the measures then? And I've broken that down into a number of sectors. So the people and employment part, as I say, the main profile that was previewed before the budget was the coronavirus job retention scheme. That was about to run out and has now been extended to September 21. And I thought it was interesting to just hang some numbers on that. So that's in Scotland, that's 360,000 employments being supported by coronavirus job retention scheme. There is a couple of little changes there, so that for the unworked hours in July and August, there's an increase, or there's a charge to employers to start contributing in July at 10%, and August and September at 20%. So there's a bit of sums to be done there. And we've certainly got a team that are doing claims for clients. And it's very complex as far as I understand it. I haven't got involved, but that's becoming even more complicated now with that. The £20 universal credit increase has been extended for 6 months, so that's good news. And working tax claimants will receive a £500 one-off payment, which is good as well. And in terms of investment, and Alison talked about investment and kind of growing businesses and apprenticeships and traineeships, there's an increase in the level of grant available there, announced in terms of England, but they will have a Scottish consequential. I'll come on to what that, there'll be a little star against a lot of these, because there's, a GB budget comes out, but some of it only applies to England. Where there's a star, there will be a Scottish consequential. We saw a draft budget for Scotland earlier in the year, and I'll talk about how that the overall number of Scotland support comes, and obviously they'll have their own decisions to make. And the stamp duty land tax cut to the nil rate band is extended, and then kind of drops back to the 125 in September 21 for England and Ireland. And obviously Scotland has that consequential change to make for itself. So that's the people and employment part, or part of that. One of the other big things that came along, arguably a bit late, but it got there, was the self-employed income support scheme. And again, I just thought I would hang some numbers on that. In Scotland, that's 431,000 people have benefited from the 3 tranches of grants, and that's £1.2 billion worth. And they announced yesterday that there'll be a 4th and 5th grant process that will go up to September 21. So that extension is really welcome. So they're available to newly self-employed up to April 20, who made tax declarations in the tax year 2020, as long as you submit it by the 2nd of March. So if you were late, you were late. And he announced that there was a grants of 80% of average monthly profit. If your profit is falling by 30% or more, and you can show that it was connected to the COVID impact as such. So I think there's detail in that. I don't just read them all out as such, but you must be able to illustrate you're actually continuing to trade as well. So it's not like you're kind of making a claim on the last throes of a business effectively. And the key thing is that the next grant will be open in April for applications, and the 5th grant will be in late July. In my experience, the process for making these claims has been quite slick. It's not like me to praise HMRC for getting things lined up properly, but they seem to have done that well. So that's been quite a useful and timely thing. People needed the money quickly, and that's been delivered fairly quickly as well. So that's the Self-Employed Income Support Scheme. In terms of businesses, we've seen CBILS and other loans previously, and he announced yesterday the Recovery Loan Scheme, guaranteed by government for 80% of the eligible loan from 25 to 10 million pounds. So that's the typo in the slide there in terms of business rates. Sorry about that. So yeah, loans very much available, very much backed by the government, and then also restart grants for the kicking off businesses that then hopefully allowed to reopen fairly soon in terms of retail, accommodation, leisure, personal care and gyms. And again, that has a Scottish read across in terms of how that's played across, but there should be money available for people who are restarting and kicking off again. And again, the business rates relief in the UK, or rather England, there was 100% relief extended, and then a reducing rate. Scotland have already extended that to March 2020 for the retail, hospitality, leisure, and aviation industries. So they've taken that step in the draft budget to do that, assuming it goes through Parliament, of course. And there were announcements in terms of support for sport, culture, museums, films and TV production, and just general recovery. Again, that's a big number, and Scotland will have to deploy the resources being given centrally down to local level. So that's the business support that's been provided. And there's a few other general measures that I thought were interesting just to bring forward in terms of some Scottish initiatives. I know there's some people on from Aberdeen, so there's a 32 million combined support for the Aberdeen Energy Transition Zone and the Global Underwater Hub, which is aiming at zero emissions and really strengthening the underwater engineering sector. I don't know if anybody's on from Ayrshire, Argyll and Bute and Falkirk, but there's some growth deals that are getting support there. And one of the things I did want to just mention, and it's one of the things Alison says, some of the stuff sneaks through on the day. When you get into the red book, and he uses one line in the speech, and we'll have some of anti-avoidance. There is £100 million going to be spent on a taxpayer protection task force from HMRC officers who are basically going to look for COVID-related support package fraud and claw some of that back. People are aware that giving grants away and money away is often a honeypot for fraudsters. So there's an attempt to attack to look at that and review that. And one of the things that means is that if you're making coronavirus job retention claims, be prepared for that to be audited and looked at by HMRC. So don't assume it's just a claim and done. One of the things that Scotland didn't benefit from in the speech yesterday was free ports. So there will be 8 free ports in the UK all of which are in England at the moment. But I know there are talks ongoing in terms of other ports in Scotland that could benefit. So they get things like enhanced buildings allowances, capital allowances, SDLT or LBTT business rates, and actually employer NI discounts as well, so that they can be quite really, really helpful. And I think the sooner the better in terms of Scotland. As soon as we can get somebody up and running, that will be good for the business world. And something else that, again, I don't know how it will apply in Scotland per se, but up to £250,000 matched funding for community ownership. So if a pub in a local area needs community support and is prepared to do something about it, the government will step in and help as well. So that's some of the general measures. And the last slide on this is really just to kind of sum up. There's also some support for what they described as help to grow. So that's support for management training, so that you can get 90% funding for, and digital funding. So if you need some software or support in the digital sphere, there's some funding around that to come. And I mentioned throughout that we've talked about Scottish consequentials. The Barnett formula is the mechanism that gives Scotland its share of the UK's tax take. The budget announced extra funding of around 1.2 billion, and that took the extra money that's been provided for next year to 3.6 billion, effectively just COVID related. So that's a lot of money to spend. And I thought I would just end on the summary point, and just going through the red book. It's very sad, but you look at the actual impact of what the budget points say. And the first 2 years we're spending loads more money, 58 billions extra. But by the end of the 5-year term, there's an extra 30 billion of tax being collected, and Dawn will outline how that's going to be achieved later on. So that's the kind of general scene setting in terms of the budget per se. My own speciality is VAT, and I was glad to see the extension of the reduced rate for the catering and accommodation and attractions hospitality sector as well, which was due to run out at the end of March. It's now going to run to the end of September. Hopefully people will be open by then and actually achieving some sales and some benefit from that. There's a kind of step change from there. From September, or 1st of October 21, the VAT rate will go up to 12.5%, on its way to 20% in March 22. So obviously businesses in those sectors will need to look at pricing, but also accounting. The tills and all that kind of stuff behind that will need to catch up. And for anybody who's really interested, 12.5% VAT is, to work out the VAT from a VAT inclusive figure, is 1/9. And again, it wasn't announced yesterday, but it's a key feature right now, is the VAT deferment payment scheme. So if you have had a deferment of VAT that was due last year, HMRC are now accepting what's essentially time to pay that over the next up to 11 months. And that's available online to apply for. So that's a really useful deferral scheme that can park some payments over the next 11 months, interest free. So that's really useful for businesses. So that's the key VAT changes. I think that's going to be the end of my slides. I'm going to hand you over to Dawn now to take you onto the direct taxes.
So thank you very much, Alan. Good morning, everyone. For those of you who don't know me, my name is Dawn McDougall, and I have recently joined the team at Henderson Loggie as a tax director specialising in tax issues that impact owner-managed businesses. And I'm going to take you through some of the changes announced yesterday, which will impact on the company, the shareholders and the employees of Tax Limited, who feature in our case study. So firstly, looking at the company position and the corporation tax rate. By way of background, the corporation tax rate, when the last Labour government left office in 2020, was 28%. And this has been progressively reduced by previous chancellors to the current rate of 19%. At the last budget, a planned further cut to 17% from 1st of April 2021 was scrapped, and it was announced yesterday, largely to help fund the COVID support, that from the 1st of April 2023, the main rate of corporation tax will rise to 25%. and that will apply to profits of over 250,000. And also from 1st of April 2023, there will be a small profits rate, which will be introduced for companies with profits of 50,000 or less, so they can continue to pay corporation tax at 19%. And also to note, for companies with profits between 50,000 and 250,000, they will pay tax at the 25% rate, reduced by a marginal relief, which effectively will provide a gradual increase in the tax rate between 19 and 25%. And despite the increase in tax rate, even at the top rate of 25%, this will still give the UK one of the lowest tax rates within the G7. So now moving on to corporation tax losses. The Chancellor also announced an extension to the period in which a loss-making company can carry back a loss to be offset against profits in a prior period, resulting in a repayment of corporation tax. So for accounting periods ending in the period from 1st of April 2020 to 31st of March 2022, the period in which a company can carry back losses will be extended from a 1 year period to 3 years. And the amount of trading losses which can be carried back to the preceding year remains unlimited. And after the 1 year carryback, a maximum of 2 million of unused losses will be available for carryback against profits of the same trade to the earlier 2 years. And worth noting, the £2 million limit applies to each of the 2 accounting periods falling within the extension period. So this is probably best illustrated by way of an example. So this company has a year ending 31st of March 2021, and it's got trading losses of 3.33 million and profits in the previous periods. So previously, you would only have been able to carry back the losses against the year to 31st of March 2020 and obtain a tax repayment of 19% of the 1.1 million. Now you can take the remaining losses of 2.23 million and set them against the 2019 profits of 1.75 million and obtain a tax repayment at 19%. And then out of the 2 million allowance for 2021, having utilised 1.75 million in 2019, there will be 250,000 to carry back to 2018. And then the remaining 2018 losses can be carried forward. And please note as well that there is a group cap of 2 million, and it will be necessary to nominate a group company to make that claim. And obviously these loss carryback rules are going to make a massive difference to viable businesses in terms of cash generation. However, it is worthwhile considering your tax profile, because the losses carried forward to 1st of April 2023, you may potentially be able to get tax relief at 25% when the corporation tax increases. So moving on to capital allowances. The Chancellor announced a temporary increase to the reliefs which can be claimed for expenditure on plant and machinery, and this relates to qualifying expenditure incurred in the period from 1st of April 2021 to 31st of March 2023. So TAC Limited, our company, has invested heavily in an extension to its factory and a new production line. And this temporary increase in allowance is going to be really valuable to the company in terms of being able to reduce its corporation tax liability. So the company, subject to its qualifying spend limit, will be able to claim a super deduction of 130% on new plant and machinery investment. And normally that new plant would be eligible for a written down allowance of only 18% per annum. Additionally, the company can claim a first year allowance of 50% on new plant machinery investment that would normally qualify for a 6% written down allowance. And that rate would normally apply to items such as electrical installations, specialist heating and ventilation. And please note the above super deductions will apply to contracts signed after the 3rd of March 2021. And just as an aside, there was no change to the structures and buildings allowance, which can be claimed on the fabric of the new building being erected by Tax Limited, which is a 3% allowance calculated on a straight line basis. And finally, to mention that the Chancellor announced an extension of the annual investment allowance, which is currently 1 million up to the end of December 2021. And since the special rate assets will only benefit from a 50% deduction, it might be worthwhile considering claiming annual investment allowance, which may cover 100% of the spend. So moving on to research and development. The government announced yesterday that there will be a review of the R&D tax credits regime to make sure the UK remains a competitive location. The consultation will be fairly wide-ranging and will consider how the private sector can be better supported in obtaining these reliefs, as the government is really keen to make the UK a centre of excellence for R&D. There were no changes made to the R&D rules in the budget yesterday, and just to recap on the reliefs which can be claimed. So Tax Limited incurs qualifying R&D spend on the design and manufacture of its machinery, and it makes R&D claims under the small and medium-sized enterprise rules, as it's got less than 500 staff and a balance sheet of less than 86 million euros. So practically, that means that they can deduct an extra 130% of their qualifying spend from their yearly profit, as well as the normal 100% deduction. So a total deduction of 230%. If the company is loss-making, it can claim a tax credit worth up to 14.5% of the surrenderable loss. And it was announced yesterday the government will proceed with implementing a cap on the payable tax credit in the SME scheme from 1st of April 2021. And that will equate to £20,000 plus 3 times the company's total PAYE and NIC liability. So R&D tax relief is a very valuable relief, either by reducing the company's corporation tax bill for a profit-making company, or by providing a refund of cash via the tax credit scheme if the company is loss-making. And worth noting that this relief can be available if you're undertaking a manufacturing project and you're looking to develop a new process, product or service, or potentially improve an existing one. So please do always consider whether or not your projects are likely to meet the criteria for R&D relief. So now moving on to the shareholder position. So looking at the family, both Mr. and Mrs. Henderson and their children work in the business. They all take out a salary and a dividend. Mrs. Henderson and the children are basic rate taxpayers, and Mr. Henderson a higher rate taxpayer, and they all live in Scotland. So firstly, looking at the rates of allowances that apply to the family. If you want to move the slide on. You will note the personal allowance has been increased to 12,570, and this will be frozen until April 2026. The capital gains tax allowance remains at 12,300, and this will be frozen until April 2026. The lifetime limit for pension contributions remains at the existing level, also until April 2026, and there's no change to the annual allowance amount, which limits the maximum amount that individuals can put into their pension pots. All family members in our case studies pay pension contributions, and Mrs. Henderson and the 2 children, being basic rate taxpayers, will get basic rate relief on their contributions. So at a basic rate of 21%, because we're in Scotland, this will mean that for every £1 paid into their pension, the pension provider will add 26 pence. For Mr. Henderson, he's entitled to higher rate relief. So currently for every £1, he will get an additional 69 pence for his £1. There has been a lot of speculation that the Chancellor would restrict the tax relief on pensions to the basic rate only. However, this has not happened. So just really to bear in mind that pensions are a very tax efficient investment, and also that the company will get a corporation tax deduction for the pension costs. So now to recap on the tax rates and bands. As I mentioned already, the Henderson family are Scottish taxpayers, and you will note that at the Westminster rates, an individual will start paying higher rate tax at an earnings level of £50,270, which is the higher rate band of 37,700 plus the personal allowance. Whereas in Scotland, this level is 56,232, which is the higher rate tax band of 43,662 plus the personal allowance. And we've also noted on the slide the tax thresholds for national insurance contributions. I do think an interesting point to note that in freezing the personal allowance until April 2026, this will bring more people into the income tax net and also the higher rate tax bands, and ultimately will increase the Chancellor's tax take from income tax fairly significantly. So now looking at dividends and capital gains tax, the Henderson family, do take a mixture of salary and dividends out of the company, and you will note from the slide that the dividend rates are lower than the income tax rates. Dividend rates are set by the Westminster government, and they were not amended yesterday. It's also worth noting that there's no national insurance costs on dividends, which can save the shareholder some tax, although you do need to weigh this up against not being able to obtain a corporation tax deduction for the payment of the dividend by the company. And looking at the capital gains tax rates, there has been a lot of speculation recently about whether capital gains tax rates would be aligned with income tax rates. I think part of the reason for this is that the divergence between the rates incentivises individuals to extract money from their companies at capital rates rather than income tax rates. And when you look at the difference between the 10% rate of capital gains tax and the highest rate of income tax, you can understand why. And just to note, the capital gains tax rates currently, as you can see on the slide, range from 10% to 28%, depending on the type of asset being sold and the taxpayer's level of income. And you will note that despite speculation that the Chancellor may look to reform the inheritance tax rates and reliefs, these have remained unchanged. And there has been confirmation that an individual's nil rate band of 325,000, which takes their assets out of the inheritance tax net, will remain unchanged until April 2026. So I now just wanted to recap on the principles of business asset disposal relief. So we noted earlier that Mr. and Mrs. Henderson are looking to retire from the business in 5 to 10 years' time. And, they've been thinking about their options. And another area of, great speculation was that the Chancellor was going to, what was he going to do to incentivise entrepreneurs? And currently there is business asset disposal relief, which you will all know replaced entrepreneurs relief in the 2020 budget. And this relief entitles the seller of shares, which have to be shares in a trading company, to a tax rate of 10% on lifetime gains up to £1 million per shareholder. And you will recall this lifetime limit was reduced from 10 million to 1 million in the 2020 budget. So just really very briefly to recap on the main conditions for business asset disposal relief. You have to be an employee or officer of the company. You have to have held your shares for a period of 2 years, and you need to own 5% of the nominal share capital in the company and have voting rights. At the moment, this relief is still available and it is really valuable. So in this instance, it's important to ensure that all the conditions are met. So we know the Henderson family are all employees, they all hold shares, but what is their shareholding percentage, and do they all have voting rights, and have they all owned the shares for a period of 2 years? It's really important to consider these conditions. So in the event of a sale, the shareholders will be able to get the very valuable 10% tax relief. And it's also worth watching this space to see if there are going to be any further changes to the business asset disposal relief conditions and capital gains tax further down the line. So I also just wanted to very briefly touch on stamp duty, as the family are in the process of buying a property in Northumberland. As Alan mentioned previously, the stamp duty holiday that is currently in place was due to end at the end of March. However, this has been extended until the end of June, and the band will reduce to 250,000 until the end of September, and the normal rates will resume from the 1st of October 2021. And in Scotland, worth remembering that LBTT is set by Holyrood, and currently the LBTT exemption ends at the end of March 2021. So in terms of employment issues, we've already had a look at pension contributions and the national insurance thresholds. A couple of other key points impacting on Tax Limited. They have an enterprise management incentive share option scheme, or EMI for short, in place to incentivise their staff. And as announced in the 2020 budget, the government is reviewing the EMI scheme to ensure it provides support for high growth companies, and to examine whether more companies should be able to access the scheme. And if the scheme is extended, this is great news for growing companies who wish to incentivise their staff. Additionally, one of the EMI conditions is the requirement that EMI participants must meet a minimum commitment of 25 hours per week, or 75% of their working time, subject to some exceptions. This has caused concern over the COVID period, when many employees have been on furlough and have not been able to meet this condition. And it was announced yesterday that employers can continue to issue new EMI share options to individuals who have been furloughed or who have had their hours reduced below the EMI requirements due to COVID, and there will be no loss of relief. I also wanted to highlight that the new rules for off-payroll working, or IR35, as it's also known, come into effect from the 1st of April 2021. And these will impact on individuals supplying their services through an intermediary, such as a personal service company, who would be employed if engaged directly by the employing company. These new rules will move the responsibility from the individual's company to the organisation employing the company, who will now take responsibility for deciding whether the individual working within the company is an employee and whether PAYE and NIC ought to be applied. And despite the fact that this has been law in the public sector entities for a while now, the new rules will have a substantial impact on the public sector. So in summary, following a lot of speculation of what may be in the budget, there were a lot of giveaways, as Alan mentioned, and extensions to reliefs to help businesses continue to navigate through the COVID crisis. In terms of paying for this and reducing the government's borrowings, the Chancellor has opted to increase the corporation tax rate for larger companies and to freeze the personal allowance, which will move more people into the higher rate tax bandings. I don't think yesterday is going to be the end of the road. There's a lot of uncertainty around in terms of how the economy is going to perform this year, and not to mention what the virus is going to do. There are many consultations currently on the table into R&D, capital gains tax and inheritance tax, to name a few. And the government have announced that there will be a tax day on the 23rd of March, which will hopefully provide more insight into the future direction of the government's tax policy. So a lot more to look forward to. Before I hand over to Charandeep, I would just like to mention our website. We deal with a wide range of tax issues affecting owner-managed businesses, and we have got some really good insights on there, which may be of interest to some of you. So please do have a look or get in touch. If you've got any specific queries which we haven't managed to cover today, we are going to send the slides out afterwards, which will contain our contact details. So thank you very much, and I would now like to hand back to Charandeep.
Thank you, Don. Thank you, Alan. That very, very extensive. I feel like I'm a tax expert now, but obviously I am not of any of that. But that was very helpful, actually, just to reflect on the changes to the tax policies, but also what has not changed and what's maintained. So thank you very much. I think that's very, very useful, particularly the business, the hypothetical business case study alongside it. I'll just share a couple of reflections from the chambers since yesterday. I guess for the first time in a long time, we had a lot more trailed in advance. So there was, that kind of pizzazz that we usually expect in budgets was probably missing from yesterday. But actually, it was helpful to see some of the potential announcements in advance from the Chancellor and the wider UK government's team. I guess for us, there's kind of three core areas that we're positioning our reflections on in terms of yesterday's announcement. I guess the first element, which was a core pillar of what the chambers were calling for, not just in Scotland but across the UK, which was clear measures to continue protecting jobs and businesses and our employees effectively. So things like the extension of the jobs retention scheme was hugely welcome. The uplift to the universal credit for those that are not in work was also really helpful to see that as well. And I guess the second area was the kind of sorting out the public finances bit, which the Chancellor has now started to lay out some of his direction on that, which we've never seen as much last year when we were at the kind of height of the crisis. So things like the increase to the corporation tax, the tapering of schemes, and then I guess the eventual removal of schemes all address the public finances angle. And then the third is the rebuilding the economy. Probably would like to have seen more in the rebuilding element, but still there was some helpful announcements in that. For example, the new UK investment bank, which will replace the European one. The announcement of 8 new free ports, of course, England only locations at the moment. Scotland is still to announce that, but the bid process, I think, is underway in due course. And I guess some measures that probably didn't get as much immediate attention that I probably just want to reflect on, particularly the fintech visa that was announced, which is due to be live in March 2022. I think that was quite interesting to see that, because it gives a clear sign and direction of how the UK government will be moving in terms of attracting talent to the UK. So I think that's a good move, particularly in the high growth industries and the kind of top level of talent that we want to continue to attract. But still disappointing that the UK government's not really moving towards clear plans on attracting talent across the skills pipeline. And this is an issue that we've been talking about in great detail over many years, and Dundee and Angus Chamber has been at the forefront of those discussions with us and making sure that all skill levels can locate in Scotland and the UK. So that's something to keep an eye on. I guess underpinning all of that, one of the areas that we are really putting a lot of focus and emphasis on is all of this will only work, including the investment side of things, if the economy reopens, on a clear plan and a clear timeline. And we're not seeing too much of that either in the UK or indeed Scotland. We are still in the height of this health crisis. And I think there probably could have been a bit more detail on that from the Chancellor yesterday. And indeed, we said the same when Kate Forbes delivered the budget on the 28th of January, is how are these budget plans being aligned with reopening the economy and the support that will continue to be needed for businesses and sectors to not just reopen, but to trade up to our operating capacity and then eventually actually start growing and create jobs. So there's still a bit missing in terms of the actual economic reopening plan. And I guess from our perspective, the incentives for investment are all very helpful, they're all very useful, and they will play a really important role in the long term to get investment back up and firing in all cylinders again. But until we can reopen, some of these incentives are really not going to make the impact that the business community needs. In addition to that, Alan had mentioned the consequential funding, and we did some overnight analysis on that too. And I'm really pleased our numbers all stack up, Alan, so that's really helpful. And I guess one of the things that we were looking at is, the headline numbers are always on the, Scotland will benefit from X billion pounds of consequential funding, and everybody gets very excited. But actually, some of this funding has already been allocated on a kind of speculative basis back in January. So from our analysis, there's probably around £700 million that's not been allocated yet by the Scottish Government. So we will be making sure that as much of that, where it's equivalent, the spend is in England, is allocated directly to business support in some shape or form. And I guess where the Chancellor's gone further compared to the Scottish Government was on the LBTT stamp duty extension that wasn't announced in January in the Scottish budget. So we will be expecting that to be mirrored in a Scottish approach in the coming days, and we've asked the Scottish Government to consider that strongly, because we certainly don't want home buyers in Scotland to be at a disadvantage compared to the rest of the UK. And I guess on the flip side, where the Scottish Government went further than the Chancellor was on the rates reliefs, and this was a #1 ask from the Chamber Network ahead of the Scottish budget, was to make sure that rates reliefs were maintained for a further year beyond the original closing of the deadline. The Chancellor didn't go as far as that for the rest of the UK, so I guess there's some benefit here for members of the Chamber Network and the wider business community that rates relief are guaranteed for the next 12 months. But again, we kind of want to move away from the support packages and rates reliefs angles, and really get into the plan for reopening the economy, and that's certainly our focus as a Chamber Network, and it's really where we're devoting a lot of our energy. And obviously that's all aligned, with the safety and health aspect, and making sure that the pandemic's under control and the vaccination rollout is moving at pace. So that's kind of where we're at right now. But overall, the budget, it was always going to be a difficult one, but we can see the Chancellor pivoting away from just a COVID-related spending and moving into kind of spend, but also tax take as well, to start balancing out the books in terms of that spend. I guess my final thought, just before I pass back to Alison, I was a wee bit surprised that we didn't hear more around the kind of shift in the economy and the post-pandemic economy that we're going to have to start rebuilding, because it certainly won't be back to business as usual. So I was a wee bit surprised that the Chancellor in some cases presented almost a, this is a blip and we'll kind of go back to normality. I was surprised that we didn't hear more around investment plans for reimagining, restructuring our towns and cities, what they're going to look like in the future. How do we move away from what we have now to thinking about, are our towns and cities going to be more focused on residential aspects? Are they going to be turning into logistical hubs, given that these are increasing areas of demand, and moving away from perhaps where we're at right now? So that's probably something that we're going to keep a watchful eye on, and these are conversations that we're having on a daily basis with the Treasury and also Scottish Government. In fact, we've got a call later at 3 o'clock with the Chief Secretary to the Treasury. So any kind of comments that are made this morning on this call, we'll make sure that they're fed back to the Treasury as well. Thank you, Alison.
Brilliant. Thank you so much to Alan and to Dawn and Charandeep for your take, which sounds a bit like we shouldn't be talking about accountants and their take, but you know what I mean, your perspectives on what we saw, and the difficult job I think that both governments have got, and then the even harder job that we have as businesses is in trying to kind of distill all of that information. So we've got some questions. I'm going to just briefly just introduce some of the other people that we have that will be around to help us answer some of those questions. So in no particular order, we've got Kimberly Thompson, who's a partner and head of tax with MHA Henderson Loggie. Shona Campbell is her colleague. She's partner and head of business recovery. We've also got Louise Mackey, who's one of their tax managers. Angela Scott Stephen, who's senior tax manager, and then of course Alan, Dawn and Charandeep are around to ask questions. If at the moment, we've got nothing in the chat specifically yet. And if anybody that's on the meeting with us wants to put their hand up and actually ask a question, I can very happily invite you in. Before we do that, I've got a question that sort of ties a little bit, I think, into what you were just saying, Charandeep, and I guess is something that any of the panel can really kind of come in and just answer for me. I saw reporting yesterday about the UK economy and being forecast to recover to pre-COVID levels by the middle of 2022. And literally 2 weeks before that, we were part of an event where a public sector agency said that the economy is not going to recover till 2024. So that's quite a difference, and I was quite surprised. And I might be leading the leading the answers. I was really surprised to hear talk of 2022 yesterday. So I'm interested in, I guess, your kind of view on that, but also I do think that ties into what we're beginning to hear businesses talk about. 2021 is going to be a really difficult year. 2020 had a lot of support in it, and you know, businesses may have been able to innovate at such a rate that actually 2020 wasn't quite as calamitous as we thought it might have been when we were sitting here a year ago or in April. So what do we think is going to be the kind of the outlook, and then how does the Chancellor recoup all that support? We've talked a bit about some of those measures, but it's a big mountain, I think, particularly using 2022 as a we're all going to be okay measure. So any thoughts from our panel on that?
I think, Alison, you know, you're right. There's a lot of modelling out there on when we're going to recover and how quickly we're going to recover. Some are more optimistic than others, but I think, you know, from my perspective, it's always helpful to, you know, to read and see these types of, you know, research documents and, you know, modelling. And I know the Bank of England are presenting a very optimistic picture in terms of recovery, particularly around the pent-up demand in consumers, households, backed up by the amount we've all been saving because of lockdown. But, you know, there's a risk there that's a short-term bounce back effectively, and then folks might retreat, you know, after a few months back into, you know, savings and being a bit more risk averse. I think the key point here, though, is the OBR, for example. They published their report yesterday as well. You know, they're saying that the economy will be 3% smaller even after recovery. So there's a lot of underlying modelling and prediction in terms of what will the economy look like. I think at a baseline, you know, for Chamber of Commerce perspective, we're being very focused on supporting the reopening, supporting SMEs to get back on their feet and help them to create jobs, because that's where the long-term sustainable economic growth is going to come from. It's helpful, obviously, you know, to have a global outlook and a UK-wide outlook and a European outlook. But at the end of the day, we need to make sure that our local communities that for example, Dundee and Angus Chamber is supporting, I've got the direct support, the practical support to get back on their feet and create those jobs. And that's what our focus is going to be for the upcoming Scottish elections as well, making sure that economic growth, backing SMEs, is at the forefront of that.
Thanks, Charandeep. Anybody from MHA Henderson Loggie want to come in, even talk about that? You know, how do we pay for all of this?
I'm happy to chip in. I think from the how long will it take us to recover? I said, I think it's how long is a piece of string. I think, you know, we were all in lockdown last year. We got to the summer and it started to look a bit positive, and then all of a sudden we were locked down again. I think it's so uncertain for the government and for businesses to be able to predict with any certainty what strain of virus might come out and how that's going to impact things. I think that we're in a far better place now with the vaccine rollouts happening around the world. So that should hopefully help contain it a little bit to enable businesses to move forward with less disruption. But I think it is really hard to predict with any great certainty at this point in time. With regards to how the government is going to recoup all the money it's spending, I think we have to give, you know, credit to the government for actually putting their hands in their pockets, albeit being taxpayers' money, to support businesses in this time. And I think it's probably worth saying that, you know, some businesses might have been left behind a little bit. So I think they tried their best to cover as many as possible but inevitably it's always going to not be a perfect solution for some businesses. I think he's tried to address that, particularly with like the self-employment grants that are available for the claim. So, it is a moving target. I think how he's going to recoup it is going to be interesting. If I'm being honest, I wasn't expecting a solid jump in the corporate tax rate from where it is right now to 25%. I thought it might be more gradual. And I also, I'm not surprised he went down that route, because I think it's politically the easiest one to take, particularly with their manifesto as well. So I don't see them deviating from the statements they made in the promises they made in their manifesto. But I do think sort of come October time, if the economy has looked like it's picking up, then I think we could see the changes that Dawn and Alan alluded to with regard to the CGT rates. And I think that is one that has been talked about a lot. So I think we will see something within the next year on that. I also think it's really interesting how much money HMRC are being given to invest in their anti-avoidance and their targeted avoidance schemes. I think what we'll see, maybe not immediately, but certainly within the next sort of 12 to 18 months, is a lot more targeted inquiries, and maybe a lot more sort of hard lines with HMRC. Often in inquiries, when you're dealing with inspectors, there's a little bit of wiggle room for negotiation about trying to reach a settlement that's fair for both parties. I think with the amount of money that's been spent, they will have teams of people looking to try and not only recover the CJRS money that's been given out if people have claimed fraudulently, because to be honest with you, if you've claimed it fraudulently, then you deserve to have it reclaimed back. But I think, again, it's a bit unfair, and I think that's something we're going to have to watch and have to support businesses with, because they kept changing those coronavirus job retention rules so often. The guidance, I mean, I know my team, and Louise can jump in if she wants to after me, trying to keep on top of all of those rules and the changes month in, month out was a very challenging time. And people were making claims based on their best interpretation of the guidance as it stood at that date. So I would be really disappointed if HMRC took a heavy hand with people in that sort of category. If it's an honest mistake, then that should be fixable without any sort of undue stress for the taxpayer. But for general inquiries into people's taxes, we'll see a lot more of those, and that'll be one of the ways that they get the money back. Perfect.
Just tying actually into talking about the job retention scheme, we've got a question about a very specific question about the 30% drop in turnover. There was a bit of confusion in some of the reporting yesterday about whether that applies to companies themselves and the changing in the job retention scheme rules, or whether the 30% drop in turnover is just relating to self-employed claims. Don't know if somebody can jump in and answer that, or if we need to take it offline and respond.
I don't mind, Alison. So what I've seen is it's just looking at the self-employed side of it, but the full guidance for the job retention scheme's not yet been released, and that will come out because a lot of changes are coming in the coming months. So I think it'll just be keeping an eye out on that. But at the moment, I think it is just for the self-employed.
Brilliant, thank you so much. Another question on company expenditure. So is there guidance available on what company expenditure might qualify for that super reduction of 130%?
So it's just generally items which would normally qualify for the plant machinery allowance, as opposed to the special rate. So the special rate is things like ventilation, special heating systems. So for the 130% super deduction, it would just be anything that would qualify for the normal 18% rate.
Perfect, that's clear. So it's
happy to provide more detail on that if anybody wants to wants it.
Yeah, because I agree, Dawn. Because I think the only thing that's a bit grey, and they haven't been 100% clear yet, is for higher purchased assets. There might be a couple extra tests that you have to jump through if you've got a higher purchased asset. But yeah, generally, as Dawn said, it should be everything.
Great. We've got a question which actually I would echo, but mine translates to the pub side of things. do we know when we might get more information about the rollout of business management training and technology support that was mentioned? And I know that that was well, I'm going to say, I think it was an asterisk point, that one, because I think that's something that we might need to see Scottish Government pick up in the consequentials, but it applies just as much to the kind of the community buyout of some of those key, you know, whether it is your pub or your theatre or something. So do we know when we might see more information about that? I guess maybe that's a Henderson Loggie question, but also to you, Charandeep, because it's down to that, some of that consequential spending as well, I think, isn't it?
I shared that with you. The data that the information I saw was very vague at this point, so it's a desire. It's a headline figure, and obviously the details will come out shortly. So obviously we'll share that as soon as we see that.
Great, thanks, Alan. You were a bit faint there. I don't know if it was just me, but basically you were just saying that the information will come out and you'll share it with us when we've got it. Charandeep, you maybe don't have anything else to add.
Yeah, we'll do the same, and I think that this will come under a devolved rollout. So we might see, you know, the likes of Skills Development Scotland potentially involved in this. So I'll take that offline and just see how that'll be supported in Scotland, because it's a key area anyway, and I know something that the chambers have asked for in great detail around making sure that our teams have management training for not just, you know, for the business, but also to get out of this crisis. And the technology aspect is hugely important, and that's a core pillar of making sure that our businesses are grasping the digital, you know, the digital wave right now, but making sure we've got the digital business skills to actually take advantage of it at the same time. So we'll take that forward and come back to you, Alison.
Brilliant, thank you so much. I mean, that very much ties into, I had a call this morning from one of our members talking about the digital funding that recently was such a success in Scotland, and whether we think that, because the UK one seemed to be more around the hardware rather than just encouraging wider investment, and I think that was where we saw that significant pot of Scottish funding. And Charandeep, one thing I was going to ask you offline, so I'm just going to really put you on the spot now, is are we hearing about an additional tranche of support like this? Do we think that there will be more funding in Scotland for some of this digital transformation and investment?
Yeah, so what we do know is that there is a digital budget that was announced by Kate Forbes on the 20th of January. It's a broad line budget, so it's not specifically yet being allocated to, for example, extending the Digital Boost grant, which is oversubscribed. But there is a pot there for it potentially to be used for that. What the Scottish Government have said is that they're waiting to kind of, I guess, assess the benefits of Digital Boost and what the business community's feedback before they allocate any extended funding to that or a similar style programme. Our position remains the same. The fact that the fund and similar funds have been oversubscribed and have been used at full capacity by the business community just demonstrates the need and the urgency and the pace that the government needs to move at. So we are keeping a very clear eye on that as part of our ongoing discussion with the Scottish Government, as well as being part of our overall plan of the Scottish elections.
Brilliant, thank you very much. I've got another couple of questions. I think, you know, we're slightly over our time, but I think we haven't really talked much about capital allowances in terms of some of the questions we've got. And we did have a question about the deductions in expenditure. So, and forgive me if I kind of paraphrase this wrong, but where does that deduction need to sit for your capital allowances for expenditure? Is it fixed assets? Is it profit and loss? I guess that's quite a technical question, but I don't know if maybe somebody wants to come in and just cover that one.
Do you want me to cover that one, Angela? Okay, I'll start. So generally, it's the expenditure sits in fixed assets, and that's where you would normally be able to make the claim from. Sometimes, however, there's maybe some capital expenditure which has been put through the profit and loss account. So it would still be possible to pick up that capital expenditure. It would obviously be added back for corporation tax purposes, so you wouldn't get a tax deduction. And then we would then add that on to our capital allowances claim. So in answer to your question, it can sit, usually, you know, it's capitalised, but not always.
Yeah, I mean, I think that, you know, that certainly fits in with just what we're talking about on that digital development investment, because quite often as businesses, you kind of, you'll do something, you know, you maybe get funding to support it, and then you have to work out how to kind of get that through your accounts in the most tax efficient way. So I think that's a really good point. It doesn't look like we have any other questions in the chat sitting at the moment, and I am conscious that we did kind of earmark your diaries just until about midday. Your tummies might all be rumbling there, and it's been a really interesting discussion. We have given you a lot of information, and there's always the opportunity after the event to kind of come back and ask anybody that was on the call, or anybody, you know, within our chamber network that we can help get you support and investment for. I think I would always just encourage everybody, you know, we have to digest this information. I'm definitely not an expert on it, and that's where you need to kind of rely on the people that give you advice to make sure that not only are you compliant, because it's important to be compliant, but that you're taking advantage of all of the schemes that we have as businesses to kind of do business and kind of look after our businesses and plan for the future. Looking forward very much to hearing about free ports and what the Scottish Government is about to do. I watched that announcement yesterday pretty carefully, because you know, there was word of X number of ports in the UK, with one possibly being north of the border. I was kind of heartened to see only 8 announcements for England and other parts of the UK. You know, Dundee is definitely looking at how it can throw its hat in the ring in terms of getting some innovation and being part of the bids into free port status. And the fact that there were, you know, Tayside and Liverpool both announced yesterday definitely has to give us cause for, you know, raising our game in Scotland in terms of making sure we get good allowances for free ports north of the border, and that we can really take advantage of these enterprise zones, or as they used to be called. So green ports in Scotland is kind of what they will be, and we hope to have more than one, and really be able to help businesses get involved in net zero and sustainability in businesses, and really grow our business communities and take advantage of that. So really, really interesting discussion. I've thoroughly enjoyed it. Thank you so much to everybody from MHA Henderson Loggie, to Charandeep at Scottish Chambers, to Sarah and the rest of the Chamber team for all their hard work, and to you all for taking part, for paying attention to us as we had you live on the session this morning. And if you've watched it on our YouTube channel and you had any questions, then please give the Chamber a shout, and we can put you in touch with anybody that was on today. So enjoy the rest of your Thursday. Have a brilliant weekend when it comes, and we'll see you at another event very soon. Thanks very much. Cheers.